Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, May 12th, and I'm recording this from our studio in Purchase, New York. U.S. equities have come back from the tariff-related trauma and are now about where they were at the end of March. This recovery is a testament to investors' willingness to hope for the best. Specifically, a combination of factors like decent corporate earnings, resilient economic data, and confidence around a benign tariff outcome seems to have allowed investors to move on, looking ahead to potential positive catalysts. While we're still cautious overall, we need to seriously consider the underpinnings of the new bull case. And with immediate rate cuts unlikely to be part of this bullish thesis, investors seem to be hanging their hopes on at least three other key developments. First is the potential for a growth stimulative tax bill. Tax legislation guidelines have focused on extending the 2017 Tax Cuts and Jobs Act for individuals and providing certain tax breaks with the idea that some of this would be offset by spending cuts. Beyond the political difficulty of achieving this agenda, we've been skeptical that such a program would be economically powerful. Not only is the plan likely to add trillions of dollars to the U.S. debt, it benefits taxpayers historically exhibiting low economic multipliers. That said, recently a more bullish tax reform scenario has emerged, with a focus on corporate tax cuts. And we're hearing about a potential corporate stimulus section in the tax bill, which would include provisions like immediate capital investment write-offs, full expensing of R&D retroactive to 2022. This could incentivize onshoring, capital investment, and the use of credit to support growth while adding just about $30 billion to the U.S. debt over 10 years, according to the Congressional Budget Office. A second scenario supporting the bull case is an acceleration of the deregulatory agenda, which could stimulate the financial services sector. According to Emerson Co. analysts, potential reforms like the reassessment of Basel III endgame capital requirements and adjustments to the supplemental leverage ratio could be enacted by late 2025 or early 2026. This could free up lending capacity in the banking system and could also help reopen deal pipelines for IPOs, M&A, and private equity exits. A third bullish narrative might come from the rejection of stagflationary risks. Fears around slower growth and higher inflation have dominated recent soft data like consumer confidence. But there is hope that sustained low energy prices could hold inflation in check. Meanwhile, strategic wins in trade deals with Canada, Mexico, Japan, India, and the EU could stimulate U.S. growth through commitments to buy U.S. liquefied natural gas, agricultural products, and defense equipment. These are all non-zero possibilities, but achieving them is going to take both luck and skill, especially when we consider the backdrop of geopolitical instability and the constraints of U.S. debts and deficits. Our sense is that this remains a trading market, not an investing one, as valuations are rich and idiosyncratic risk is high. Investors should hold tight to their financial plans and consider maintaining maximum portfolio diversification by asset class, sector, and region. As for the S&P 500, long-term investors should consider 5,100 to 5,500 a very defensible entry zone if recession is held at bay. That said, equal weighting or active stock picking is still preferred to the passive index buy. And finally, we have rebalanced style biases back to neutral, focusing on quality growth names with achievable earnings estimates. We see value in the belly of the Treasury yield curve and suggest scouring the municipal sector for opportunities. Thanks, as always, for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.